United States Federal Open Market Committee at its meeting yesterday held rates but still signaled 2 interest rate cuts this year. Updated summary of economic projections also showed the expected lower economic growth plus higher inflation and slightly higher unemployment rate, but all amid uncertainty, not just on forecasts, but on the impact of factors like the new policies of the US administration, that's the Trump government. Hello, welcome to Global Business Insights, where we analyze the main business stories. The main story today focuses on takeaways of yesterday's statement from the Fed and press conference after the meeting of the FOMC at which rates were held steady. The wait-and-see stance satisfied Wall Street as at close. Dow Jones gained 0.9%, S&P 500 also rose, Nasdaq Composite also gained. US stock futures also rose as investors digested reassuring signals from Federal Reserve Chair Jerome Powell yesterday. Markets were not expecting a rate change, and the FOMC had both dovish and hawkish aspects in their press release and statement of projections. The US stock market was most likely encouraged by the fact that most FOMC members, 9 to be exact, still expect 2 rate cuts, despite an upward revision in inflation, with core PCE going up to 2.8% from 2.5% in the December forecast. But 8 members expected less than 2 cuts, which is, you could say, a hawkish slant. Annual US GDP growth in 2025 was also revised down to 1.7% from 2.1%, which some say foretells a dovish positioning, while Powell, in questioning after the press statement, explained that inflation uptick is transitory and in the longer run will fade. Transitory is back. He couldn't say with certainty if tariffs were mainly responsible, adding that a combination of several policies have to be factored in to determine the impact on inflation, and for now it is too early to make any such determination as policies are still at very early stages, adding that the economy and the labor markets are still strong despite the hint at a stagflation and higher chance of a recession. The Fed also say they were slowing down in the pace of shrinking the balance sheet, that is quantitative tightening or the runoff, where positions are allowed to amortize, shrinking the balance sheet without being replaced. They said that as part of the reduction in the pace of quantitative tightening, the monthly cap of treasuries that will be allowed to mature and not be replaced will be reduced to $5 billion per month from the prior $25 billion monthly cap, effective on April 1. The unemployment rate projection was also increased to 4.4% in 2025, not a material change from 4.3% in the December projections. By not reducing rate cuts, it suggests the FOMC is more concerned with economic growth than with the rising inflation, seen as stabilizing in the longer run towards the 2% target. So how can we summarize Powell's presentation? I would say it presents a solid labor market, still strong economy overall amid more uncertainty and higher risk of a downturn. Powell is not worried about tariffs, and there is, according to Powell, no hurry to move on rates, and there is time as well to be cautious, to await clarity or confirm trends before further moves. The base case that an inflation uptick will be transitory will also need to be watched as policies and their impacts are better understood. But let's listen to Powell.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The economy is strong overall and has made significant progress toward our goals over the past 2 years. Labor market conditions are solid, and inflation has moved closer to our 2% longer run goal, though it remains somewhat elevated. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. We also made the technical decision to slow the pace of decline in the size of our balance sheet. I'll have more to say about these decisions after briefly reviewing economic developments. Economic activity continued to expand at a solid pace in the fourth quarter of last year, with GDP rising at 2.3%. Recent indications, however, point to a moderation in consumer spending following the rapid growth seen over the second half of 2024. Surveys of households and businesses point to heightened uncertainty about the economic outlook. It remains to be seen how these developments might affect future spending and investment. In our summary of economic projections, the median participant projects GDP to rise 1.7% this year, somewhat lower than projected in December, and to rise a bit below 2% over the next 2 years. In the labor market, conditions remain solid. Payroll job gains averaged 200,000 per month over the past 3 months. The unemployment rate at 4.1% remains low and is held in a narrow range for the past year. The jobs to workers gap has held steady for several months. Wages are growing faster than inflation and at a more sustainable pace than earlier in the pandemic recovery. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance. The labor market is not a source of significant inflationary pressures. The median projection for the unemployment rate in the SEP is 4.4% at the end of this year and 4.3% over the next 2 years. Inflation has eased significantly over the past 2 years, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.5% over the 12 months ending in February, and that excluding the volatile food and energy categories, core PCE prices rose 2.8%. Some near-term measures of inflation expectations have recently moved up. We see this in both market and survey-based measures, and survey respondents, both consumers and businesses, are mentioning tariffs as a driving factor. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 2.7% this year and 2.2% next year, a little higher than projected in December. In 2027, the median projection is at our 2% objective. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5%. Looking ahead, the new administration is in the process of implementing significant policy changes in 4 distinct areas: trade, immigration, fiscal policy, and regulation. It is the net effect of these policy changes that will matter for the economy and for the path of monetary policy. While there have been recent developments in some of these areas, especially trade policy, uncertainty around the changes and their effects on the economic outlook is high. As we parse the incoming information, we're focused on separating the signal from the noise as the outlook evolves. As we say in our statement, in considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will assess incoming data, the evolving outlook, and the balance of risks. We do not need to be in a hurry to adjust our policy stance, and we are well positioned to wait for greater clarity. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. An admittedly challenging exercise at this time in light of considerable uncertainty. The median participant projects that the appropriate level of the federal funds rate will be 3.9% at the end of this year and 3.4% at the end of next year, unchanged from December. While these individual forecasts are always subject to uncertainty, as I noted, uncertainty today is unusually elevated. And of course, these projections are not a committee plan or a decision. Policy is not on a preset course. As the economy evolves, we will adjust our policy stance in a manner that best promotes our maximum employment and price stability goals. If the economy remains strong and inflation does not continue to move sustainably toward 2%, we can maintain policy restraint for longer. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we can ease policy accordingly. Our current policy stance is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. At today's meeting, we also decided to slow the pace of decline in our balance sheet. Since we began balance sheet runoff, our securities holdings have declined by more than $2 trillion. While market indicators continue to suggest that the quantity of reserves remains abundant, we have seen some signs of increased tightness in money markets. Beginning in April, the monthly cap on Treasury redemptions will be lowered from $25 billion to $5 billion. Consistent with the committee's intention to hold primarily Treasury securities in the longer run, we are leaving the cap on agency securities unchanged. This action has no implications for our intended stance of monetary policy and should not affect the size of our balance sheet over the medium term. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I will look forward to your questions.
Donald Trump was not invited to the FOMC meeting, but he still had his say, as he said he would. He wants the Fed to cut rates as tariffs ease their way into the economy. And it sounds like he would have preferred the Fed to cut rates immediately. Jerome Powell has repeated that decisions will be guided by the data and the analytics. Tomorrow we'll look at the Bank of England's MPC decision and the South Africa Reserve Bank's policy review as well. Now for some more business stories. The era of branch banking in the UK is slowly coming to an end, it seems. Santander has announced it's set to close 95 branches across the UK, putting over 700 jobs at risk. This was as customers were banking more online. Also, as part of the changes, Santander will reduce hours at 36 branches and remove the front counters from 18 others. Amazon lost its legal fight against a record $800 million fine handed out by Luxembourg's privacy regulator 4 years ago as the courts sided with the watchdog. The watchdog had penalized Amazon for processing personal data in breach of European Union General Data Protection Regulation privacy rules. Donald Trump yesterday said he had a very good call with Ukrainian President Zelensky as the US works to broker peace agreements between Kiev and Moscow. A Kremlin official also clarified that the agreed 30-day ceasefire concerns energy facilities and no other forms of infrastructure. And in New Zealand, gross domestic product rose 0.7% in the December quarter from the prior quarter, better than expectations of a 0.4% increase. The growth also followed a revised 1.1% contraction in the third quarter. The European Commission has put forward a proposal that arms companies from the US, UK and Turkey will be excluded from a new €150 billion EU defence funding push. The planned funds would only be open to EU defence companies and those from third countries that have signed defence agreements with the bloc. And in Nigeria, the Dangote refinery yesterday announced the suspension of petroleum products being sold in Naira, implying that it cannot continue to dispense in the local currency while purchasing crude, for example, in dollars. Asia-Pacific markets traded mixed as China's central bank kept interest rates steady. The People's Bank of China kept the one-year loan prime rate at 3.1% and the 5-year LPR at 3.6%. Well, that's all in this episode of Global Business Insights. We are on Business Day TV on the Business Day website. Thanks for watching. Bye-bye.